Welcome back, friends, to another weekly video. It's been another bad week for the stock market. Since Tuesday, the Dow is down 4.7%, and this has raised a lot of fear in people that the market might be changing to a downward direction. Now, in order not to get caught up in the fear, it's helpful to take a step back and look at the bigger picture, and that always helps you make better financial decisions. So in this video, we're going to be answering the question, what happens if the stock market bubble bursts? To start, let's take a very big picture look at what's going on. You can divide the market into two main groups of investors, bulls and bears. People who are bullish in the market think the market is going to increase and make investing decisions based on that theory. People who are bearish think the market is going to decrease and make defensive investing decisions. Finance is about mitigating risk. You want to understand both perspectives at any moment in time. So even if you think the market is going to increase, you still want to understand what bearish investors are thinking so you can prepare against potential downside risks. So what are people saying right now from both perspectives? Bullish investors are talking about how the economy is reopening. As the economy gets stronger, it should push stock prices higher. Bearish investors are saying something quite different. Bearish investors are saying that we currently are in a stock market bubble, and when that bubble pops, it's going to create an enormous amount of pain. I don't make predictions on this channel, so I'm not saying whether we're in a bubble or we're not in a bubble. You can make that decision for yourself. But I do think it's helpful to walk through this scenario. What happens if we are in a bubble? Because no matter who is right here, if you walk through the scenario and understand your risk, it'll help you mitigate risks in your own investment portfolio. So let's start by talking about two myths in the stock market. Myth 1, the stock market is guaranteed to increase forever. False. There are a lot of examples throughout history of financial markets that crash and never recover again, ever. Prices are never guaranteed to go up, and you need to recognize that as a potential possibility. At the very least, there is a scenario of a crash and a recovery period that exceeds 30 years. 30 years is a long enough period of time where it might as well not have recovered at all because you still would have never recovered your earnings by the time you have to retire. Myth 2, there will always be demand to invest in stocks. False. A stock is just a product you can buy. But in the investment world, there's lots of different products. People do not have to invest in stocks at all. People can invest in real estate, they can invest in bonds, people can invest in private businesses, they can invest in their own education. So if people start thinking that the stock market is not likely to generate a return, they're going to start looking at other places to put their money. Just one example that I think could happen is I think people could start investing more in real estate in foreign countries outside of the United States. Because if people have all this money to invest and the stock market looks a little uncertain, they're going to look at other investment alternatives. And if you have a bunch of money, you're looking for somewhere you can put it that will have a return. If you invest in a foreign country in their real estate, it not only has the potential to increase in value, but also gives you options for you and your family for other places to live. The point is, people don't have to invest in the stock market to get a return on their money. So when you start looking at these two myths, you start to realize how risky the stock market actually is. So let's look at the additional reasons now why people are thinking we're in a stock market bubble. The market is acting irrationally. Since the crash in March, the Dow is up 35%. At the same time, the global economy is a disaster. The Dow actually broke above pre-COVID-19 levels. Just think about that. People are paying the same price for stocks when the economy is so much worse. So if the economy keeps growing at this rate, you will more than double your money in a year. This has created a lot of confusion. How can the stock market be so great while the economy is so bad. At the very least, this should raise concerns that something strange is going on in financial markets. 2. Prices are being driven by speculation rather than dividends. These are the two factors that drive stock price. Stock is an ownership percentage in a company. So for some companies, you receive a percentage of profits each quarter in a dividend. You can determine the present value of cash flows you expect to receive from owning the stock and then determine an acceptable price. This is called investing based on fundamentals. However, you can also make money through the stock appreciating in value and selling it for a profit. Changes in price are based on supply and demand for the stock. That is based on speculation. And if speculation is driving prices as opposed to fundamentals, it becomes more risky because supply and demand for stocks can change and prices can drop. We can measure this by looking at stock price compared to company earnings, or price to earnings ratio. This is a great chart from longtermtrends.net that shows S&P 500 PE ratios since the 50s. The green area shows prices in what would historically be considered fair value. We see that during recessions like the dot-com bubble and the housing crash, that the PE ratio tends to increase as company earnings drop. Number 3. Aggressive Federal Reserve actions are unprecedented. The Fed is funding liquidity. This means that if a company is struggling to issue debt, the Fed will come in and make sure they can get that debt. So even bad companies that no banks want to lend to will be able to get debt. This essentially means that no company should be going bankrupt because even if they have no revenue, the Fed will make sure they can get debt to pay their bills. This removes all the downside risk from owning stocks. So normally, if a company goes bankrupt, you lose all the value of the stock. But if no companies can go bankrupt, the Fed has removed that risk of owning stocks. In this scenario, two things can happen. The Fed is going to roll back these liquidity measures eventually, which will create downward pressure on stock prices as companies go bankrupt. Or stockholders will realize their stocks are not worth as much as they thought and start a sell-off. Once a sell-off starts, there's no way to stop it because no one wants to be the last person to sell their stocks. There is a fundamental issue here. The Fed has removed risk from the stock market. So the Dow has increased 35% in one quarter. In this environment, you could make more money sitting at home and investing in the stock market than you would by going out and getting a job. There is a disincentive for people to go out and work is what the US needs to get out of this financial crisis. Financial markets do not work without appropriate risk profiles, which means that banks should not be lending to companies that don't deserve it, and people should not buy stocks without pricing in the possibility of losing all of their money from a company bankruptcy. Now I want to hear from you. We've talked about two scenarios here, a bullish scenario and a bearish scenario. What do you think is going to happen? Go ahead and leave a comment in the comment section down below. I love reading your comments because I always get comments from both perspectives. So I want to hear from you. Go ahead and leave your comments down below. Stay safe out there, everyone. I'm Zach from Wolves in Finance. Let's go out and make some money.